Welcome you all to today's section. We are going to continue where we ended from last section. That is the consolidated statement of financial position. We are still at the standard workings. Good. Great. So we did last time, we look at the standard workings. And we said that the standard workings start from number one. We have 1A, 1B, 1C. Remind ourselves, we started from where? The group structure. That is the first workings you have to do. The second, we said it is what? Effective date of acquisition or control. Effective date of what? Control or acquisition. And lastly, we said period of what? Consolidation. And we look at examples of this. Great. Today we are going to standard workings number 2. Workings 2. That is the cost of consideration or cost of control. So workings 2 is what? Cost of consideration or cost of control. Good. Okay, so cost of control or cost of consideration. Cost of control is very important, or cost of consideration. Cost of what? Consideration. So control or consideration. Consideration, okay, or cost of control. Now, with the cost of control, when parent acquired a subsidiary, the total cost that the parent incur for acquiring that subsidiary, that's the cost of control. Basically, that is it. Cost of what? Control. It's an interesting area that you have to get it for me. Some sessions, you don't need to lose any mark there. We also call it fair value of consideration. Yes, fair value of what? Consideration. It also mean the same thing. Now, if you go and acquire another entity, what are the possible ways of paying for? That's a payment. You've acquired shares from your subsidiary to gain control, whether fully or partially. What is the total cost involved? Basically, it's made up of 3 to 4 items. You are done. Now, the cost of control or the cost of consideration can be in the form of what? Cash payment. So cash, so much. So Ghana shouldn't be here. Cash, so much. That means you can acquire a subsidiary. You can acquire a subsidiary and you pay for cash. That is it. Then you have what you call share exchange. You normally give it a nickname called share for share. So share exchange. Share exchange. So much. Share exchange. Here you acquire the subsidiary and you pay using your shares. So you give the owners of the subsidiary some of your shares to cater for any payment. So you're supposed to pay, let's say, 30,000 Ghana cedis for the owners, yes, of the subsidiary. So company A acquired company B. Company A have to pay 30,000 to the owners of company B so that they can surrender their shares to you, so that so that you be what? The parent, or to gain control. To gain control. The issue is that I don't have physical cash to give this 30,000 to the owners of company B. So what do you do? Okay, can I pay with my shares? Oh yes, I'm giving you shares over here with a value of 30,000 at this value, so that to cater for the 30,000 is supposed to give you. So that is it. So we pay with what? Shares. And we call it share exchange. We have given it a nickname called share for share. So share what? For share. That's the nickname. Is that? Good. We will take a full account of it. So if I here, we will take a critical look at it and do everything about it. So here the parent is giving the shares to the owners of the B, the subsidiary company, to cater for the payment. That is the share for share or the share exchange. Good. So you can acquire a subsidiary by giving physical cash or part of cash, part with cash, part with share exchange. So let's move on. They have what you call deferred consideration. Please, in reality, you can even pay with your taxi. You can pay with your vehicle. In reality, swapping or payment in kind. But for the purpose of examination, these are the items that we are going to probably use. The next item, so the next item is deferred consideration. Deferred consideration or deferred payment. Deferred consideration, so much. What is deferred consideration? With a deferred consideration, here you promise that I will pay you another 10,000 Ghana cedis. In fact, not now, 2 years' time. So you defer the payment into later days. Have you get it? Good. So that's the deferred consideration. We will take a critical look at all of them. Share from share to the last one, they have or they need attention, and we give it to them. Good. So no wonder in November 2018, the examiner asked them to explain how you can account for what? Deferred consideration. Then lastly, contingent consideration. I like that. The stubborn ones. So contingent consideration. So much. So this will give you the total consideration. So the total, that is it. Sorry. Good. Now, deferred consideration means part of the cost that you have deferred into later days or future periods. Here, all what you need to do is to find the present value. In fact, we will take our time and start from share for share and look at how to treat each of them one after the other because they are very topical issues. November 2018, we asked them this. It's just explain to us how to treat them. Good. Now, contingent consideration is a consideration that depends on a condition. Okay, I'll pay you 10,000 again in 3 years' time if and only if your profit after tax is greater than mine. Contingent consideration. So contingent consideration is a consideration that what depend on what? A condition. or performance obligation. If your profit can be, if you can increase your profit by 20% consistently for 3 years, I will pay extra money to you. That is contingent consideration. I am done. Now, let us go through the accounting treatment of each of them. For cash, you don't need to worry. If you pay cash, how do you treat it? In the books, by the parent, by the subsidiary, in consolidation. So, cash payment. So, you bring it here, double entry will be here, and then the parent will add it to its investment, but we are going to reverse that. So, don't worry. We bring it, and then parent will subtract it from the cash if it has not been recorded. So in exams, two things will happen. Either they'll tell that it has been accounted for, that means it has been recorded, or it has not been recorded. Good. I am taking the case where they have not recorded it, so you have to do everything yourself. So cash, if they have not recorded cash, what do? After bringing it here, what's the next section? Who make the payment? It's the parent, right? So parent cash must gone down. So go and subtract it from parent cash. So subtract it from where? Parent cash. In the statement of financial position after bringing it here. So two treatments. I am down with cash. Let me go to share exchange. Let me go to share exchange. That's where the issue is. Now here, we are paying for shares. We are buying shares and paying with shares. So that's what we call share exchange or share for share. Now the issue is this. To get a value, we just have to find the number of shares given out. So to get a value, just get what? Number of shares given out multiplied by what? The parent share price. So this, to get this value, is nothing but what? Number of what? Shares given out or exchange. Number of shares what? Exchanged times the parent share price. So P's share price. Why the parent share price? Because the shares are for who? The parents. I'm giving you shares. So we have to use the parent share price. That is it. So to get a value, the number of shares. But here, this one will not be easy. The number of shares, we won't give it to you. Good. So we are going to give you the ratio 1 for 4, 2 for 5. Good. Or 1 for 5. So we are going to express this as ratio. So we go through series of them. Good. So we start from 2016 May up to last thing and look for the share for share. About two of them and then just treat them. Then we are done for the share for share. How to treat the share for share. Good. Now, the issue is this. Anytime you see parent share price given to you in the console question, if you see parent what share price is for share, that means that person will be share for share in it. So take note, when there's parent shares, the price or the value has been stated is for share for share. That is all. Okay. So let's try this. So let's use this example. So okay. So the question goes like this. Let me clean here and then put it here. Justice Mahmood Dauda. Justice Mahmood Dauda which sometimes we call Justice Dauda Mahmood. So that's JDM, right? Okay. I mentioned Justice Dauda Mahmood. So JDM Limited, Justice Dauda Mahmood Limited acquired about 75% of the 4,000 equity shares equity shares So sorry about that. The sound wasn't coming. Now the question goes like this: JDM Limited acquired 75% of 4,000 equity shares of JNOA Limited. Good. By a consideration of one new shares in JDM Limited for every four shares acquired. Good. Full stop. At the date of acquisition, JDM share price stood at 5 Ghana cedis. At the date of acquisition, so that's the last sentence. At the date of acquisition, JDM, JDM share price, JDM share price stood at what? 5 Ghana cedis. Full stop. Account for the above. How are you going to treat this? So I'll look at this and then move on. Great. So we are just going to calculate the share for share section or the share exchange. So let's take the question again. First, all what you have to do is, so when you go to step 2, the solution. Yes, 2.5 series. Solution. When you go to your workings 2, that examiner cost of control. Cost of what? Control or cost of consideration. Cost of consideration. That examiner share exchange. So bring it here. Share what? Exchange. Don't worry. Then open your brackets. Perform the workings there. Get the number of shares acquired by JDM. That's all. How do you get the number of shares? JDM acquired 75% of the equity shares. What is the equity shares here? 4,000. Wow. So if it is 4,000 equity shares, if you acquire 75. Okay. So that would be 3,000 shares, right? So JDM acquired 3,000 shares. That's the first thing that you have to look out for. The number of shares acquired by the parent company. By what? The parent company. Good. So it's 4,000 shares because you acquire 75 out of the 4,000, so you get what? 3,000. How did JDM pay for these 3,000 shares? Money wasn't there, right? Yes. So what do? JDM decided to issue some of the shares to cater for the payment. So by 1 new shares in JDM for every 4. So here what you do is, now the 75% times 4,000, this will give us the number of shares acquired. It ends there. Then times the ratio. Always get a ratio. Get the new one on top. Get the existing shares acquired down. Shares acquired. Put it down. That's all. So that's the ratio. So new shares in a parent over the shares acquired from the subsidiary. How many shares do you took over? So that's times what? 1 out of what? 4. This will give us just the number of shares. Number of what? Shares. Times the share price. So what is the JDM share price at that date? Please use at the date of acquisition, not at the date of reporting. So at the date of acquisition, JDM share price is what? 5 Ghana cedis. It's 5 Ghana cedis. So what will be the value? Is it there? So what will be the value? So 75% times 4,000 times 1 out of 4 times 5 Ghana cedis. Any answer that you get valid, put it in there. So 3,750 Ghana cedis. You are done. What is the accounting treatment and console treatment? Accounting treatment and console treatment. For now, if it has not been recorded, and that's what we are doing, we are going to record it by ourselves. So go to the parent share capital, JDM share capital. Whatever JDM share capital is, go and add it. So accounting treatment of this. Treatment must be 2. Treatment number 1, add it to the parent share capital, the one who made the exchange. That's here in this question, JDM. When you go to the consolidated statement of financial position, you bring the share capital and you add 3,750 to it. Why? Because after the acquisition, right after the acquisition, JDM have what? Issued shares which have not been recorded. Please, if it has been recorded, don't go and add it there again. Don't go and add again to be double counting. So if they have not recorded it, what do? Record it. And I can assure you that most of the share for share, we are not going to record it. Share exchange, we are not going to record it for you at all. You have to do it for us. So basically, that is it. Most of the share exchange transaction. you have to record it for us. Okay. So the share exchange, that is how we are going to treat it. Okay, great. So that's the treatment. So treatment number one, add it to the share capital of the parent. We are done. Treatment number two, add it to the cost of capital. Sorry, the cost of control. That's what we've done here. So treatment number one, you add it here. Treatment number two, go and add it to what? The parent what? Share capital. We are done with share exchange. I'm done. Now moving on to deferred consideration. Okay. We are continuing the question. I'll just extend it. I'm going to extend the question. Great. So that's a share exchange. Good. So this will be maybe note one, note two. I'm just continuing the question. JDM Justice Dauda. Justice Dauda Mahmood. Okay. Limited. JDM Limited. JDM Limited. In addition, have to pay 10,000 Ghana cedis or 10,000 is too much. We'll pay 5,000 Ghana cedis in 2 years time. 2 years time. In 2 years time. In 2 years time. Full stop. The cost of capital for JDM is at the rate of 10%. So cost of capital for JDM. Cost of capital for JDM is 10%. Cost of capital for JDM is what? 10%. Now we are on deferred consideration. So I will explain the treatment of deferred consideration. First, for deferred consideration, relax. Any consideration that you pay in future, 2 years time. So if I've inserted date in this question, I'll give you the date. If I acquired a company, maybe 1st January 2018, so 2 years time, exactly 1st January 2020, you make that payment. Good. So the accounting treatment of deferred consideration. Step one, find the present value of the deferred consideration. That's the first step. Step one, find what? The present value of the deferred consideration. Why? Because that payment is in future, year two. It's too far. We are calculating the cost of consideration now. So find the present value. 5,000 payable in 2 years time. What's the value today? That is all. Find what? The present value. Because we are not calculating cost of consideration in 2 years time. No. We are calculating cost of consideration in year zero. That's now, today. So what's the value? Find the present value. That's the step one. Okay. Now, if you find the present value, have you paid the money? No. So it's a provision. So it's a liability. You add it to what? Your liability. If it is more than a year, that's non-current liability. Within a year, that becomes current liability. So that's the step two. Step two. Immediately, liability will be be stated for. Okay, so now I can take off the first section. Let me take off what so that I can spell out the steps in here. So for deferred consideration, all what you need to know is step 1, just find the present value PV of the consideration. That's step 1. Step 2, record a liability. Record a liability, that's the provision. The same amount, to the same value of the same value. Step 3, unwind the discount each and every year. We are done. That's where the issue is. Step 3, what do? Unwind the discount each and every year. Unwind what? The discount. I will explain. So we did this one under IS 16. Okay, we said I'm going to make it again. This is a section. Unwind the discount at the end of each year. That's all. So these are the 3 steps for deferred consideration. Any payment made ahead of time. Why are you going to unwind the discount? You know that if you find the present value, you have to be increasing it. Good. So that's all. Now, can I take the question off and then present the solution? Yes. So JDM is going, gone. Okay. So solution. So cost of consideration or cost of control. Share exchange. We've calculated that one already. So share exchange. This example is a build-up example. We had 3750 from the previous. Now we write deferred consideration. Deferred consideration. Deferred consideration. Deferred consideration. So deferred consideration. Open your bracket, find the present value. You are done. What's the present value of this deferred consideration? The present value will be the present value formula. This is the second time for us to state this. It's equal to the future value divided by 1 plus what? The cost of capital. That's the rate. All to the power of n. When exactly you are paying it. So fair value or the future value. The future value is what? The future value of this payment is 5,000 cedis. So 5,000. Cost of capital is what? 1 plus 0.1. When are you paying this money? Exactly 2 years. So that's all. Please, what is the value? So 4,000. So 4,132. Good. So therefore, the total consideration will be 7,882. So if you should end here, that's the total consideration transferred to acquired the J paid by the JDM to acquire JNO. Okay. So basically, that's the step 1. Have you seen just one step we've done? You go to step 2. Here too, I'm very certain that they will not account for it and they will ask you to do the accounting treatment. How we get it? They will ask you to do what? The accounting treatment. So if you've not accounted for it, what do? You have to record a liability. So parents, go to parent liability and add what? 4,132. But here, there was an issue. Let's solve the issue first before recording the liability. Okay. Now, This 4,132 perform magic or perform something that at the end of the 2 years, you will get 5,000. Today, year zero, today, the value is 4,132. Agreed. That's the value today. Exactly 2 years time, perform my magic so that it will be 5,000. That's 2 years. So you see, look at the term. You discounted it, you get the present value. So to remove the discount from this figure and double it, so increase it. So we can call it on discount. On discount will not be nice. So the only term that we saw was unwinding the discount or unwind the discount, meaning I call it what increase in provision. Be increasing this value or figure every year so that at the end of the second year you get what 5,000. So what do you do? How do you do the increase? Just multiply the present value that you had by what? By the discount factor. That is it. So that's what you do. So now that we are done with the asset section, let's go into the liability section. So the liability section will look like this. First, liability at the start. The balance brought down to be 4,132. That's the liability at the start. Then there's another unwinding of what discount. Open a bracket. Take the liability at the start, multiply it by the discount factor, which is 10%. That will give us, so if you multiply, let me do the workings here so that you see it clear. 10% times what? 4,132. Agreed. That will give us 413, right? Okay. So the unwinding of the discount will be 413. You add and get a liability at the end. So that will give us 4,565. Agreed. So that's the balance carried down. And that's the liability at the end of the period. Okay, so 4,545, right? So 4,545, 45, 45. Good. So basically, that is it. So in short, this amount of discount, it must be subtracted from who? The parent profit. Now let's start all over again. We said that we have to perform magic so that at the end of the 2-year period, that 4,132 will be what? 5,000. And we call it unwinding of what? Discount. So that one will be treated at the liability section. So what's the open balance of the liability? The open balance was 4,132. Then third examiner, unwinding of discount. This is the game. I have to make payment. I don't know year 2. So year 2, year 1. I have to go and pay 5,000 there. But now the value is what? 4,132. So what should I do? So that at the end of the 2-year period, the value will be what? 5,000. I discounted it. So the reverse of discount, discounting a figure is called unwinding of what? The discount. Remove the discount. So what do you do? So let's just increase the provision. So in short, I just have to look for my discount factor. Discount factor was 10%. So I'll multiply this one by 10%. I'll get what? 413. So that means if I add this to this, now the value will be what? 4. If I add this one to this one, to increase the value, I will get it at the end of year 1. Then I'll find another one again in that order. So here, if I add this to this, yes, please, it's part of the solution. You need to get everything. Good. So that is it. Don't worry, I'll give you the shortcut version. Don't worry. I just do this. Add this one to this one, you get 4, 5, 4, 5. So that means at the end of the year one, the liability will be 4, 5, 4, 5. So that the next year, it will now increase to 5,000 exactly. Next year, it will increase to 5,000 exactly. Perfect. So basically, that is it. Let's continue the game. So find the unwind of the discount. Open a bracket. Tell the examiner that is nothing by 10% times 4132. You get 413. Add. You add, you get 4545. And that will be what? The balance carried down, the liability at the end. We are done. This must be subtracted from the parent profit. It's a finance cost. It must be treated as what? Finance cost from the parent profit in a group retained earnings. You will get there. In our group retained earnings, finance cost. Great. Then this will go to the non-current liability. Non-current what? Liability. It must be added to the liabilities. Why? Because if you don't pay for that amount, it has been deferred into the future. You are owing. Just that at the start of the year, at the date that you acquired the subsidy, you are owe the person 4132. But that year period, it has increased. Yes, that's increased to what? 4545. Then you are done. So this is the summary of the accounting treatment. In exams, when they ask you, first find the present value, add it to your cost of control or cost of consideration, then relax. Just find multiplied by the cost of capital or the discount factor to get the increase in provision, top it up, send it to the financial position. You are done. So that's the end of the game. Now let me explain the last section of the cost of consideration. The last section of what? Cost of consideration. Good. Cost of consideration. The last section is what we call the contingent what? Consideration. Contingent consideration. So let's move on to the contingent consideration, and then you define. So this is what? The treatment of what? Deferred consideration. Press step 1, 2, 3. You are done. Good. So basically, that is it. Now, it means that this is at the end of year one. At the end of year one. So when you go to year two, what you do is in year two, let me clean here. Continuation. When you go to year two, you just have to find the unwind of the discount. So this year two, unwinding of what? Discount. Just multiply this one by 10%. Yes, if you multiply by 10%, you get 455. You add, you get exactly 5,000. That's the closing balance. So I don't know year two. You'll be paid this figure in where? Year two. You're going to pay this figure in year two. So I don't know year two, it must be 5,000. So please, at the end of year one, just end here. This is the ending section. That's where we have performed our accounting treatment. Good. So at the end of year one, we are going to end here. If you continue again to the year two, to give you the 5,000, which will be equal to what you're supposed to pay. How we get it? Good. So now let's move on. Great. So we are going to the contingent consideration. With the contingent consideration, it's a bit okay. contingent consideration. Now, is a consideration that depend on what? A condition. Agreed. Consideration that depend on what? A condition. How do you treat it? For the treatment of contingent consideration, normally move in line with the deferred, the subset of difference, a little different. Now let's see. This is where I'll promise you that I'll give you another 30,000 Ghana cedis if and only if the subsidiaries profit after tax exceed your 80,000 Ghana cedis. That's all. Now, in the old standard, IFRS 3, business combination, it will tell you that relax, don't account for it until the subsidiary have what? Fulfill the condition. But after the revision, it said no. After the revision, it will require contingent consideration to be provided for. How? So here, we said that get a fair value at the start of the year, the fair value. So what's the likelihood of them achieving this condition? Oh, at the start of the year, they have 100% hope to achieve this. So that's the fair value. So get a fair value of this consideration. So let's assume that the fair value is still at 30,000. So you are likely to pay this 30,000 to them. Don't worry. The standard is saying that at the end of every reporting period, measure the fair value. That's the likelihood of what? The subsidiary achieving this profit or achieving the condition. Because if the subsidiary achieve that condition, you have to give that money to the subsidiary. Good. So, in short, in simple quotes, at the end of every period, compare the fair value at the start to the fair value at the end. If there's any differences, record it in the group retained earnings. It must be accounted for in a group retained earnings. That's all. Group retained earnings is a section where the entire profits, both the parent owners, and then the other component of what? The retained earnings. So other components of equity, all of them are in there. If it is a gain, you add. So let's cite an example here. So our example. So step 1, find the fair value of the consideration, of the contingent consideration. And then key it in, record it. So record it as what? Fair value. Step 2, at the end of each reporting period, end of what? Each reporting period. Each reporting period, compare the fair value at the beginning. Compare the fair value at the beginning and the end. And the differences must be reported in where? Group retained earnings. The difference must go to where? Group retained earnings. I will explain. The differences must be added or reflect in the parent profit. Wherever the parent profit is, must go there. Okay, that's all. So, example, the fair value at the start was 30,000. That was the fair value. 30,000 Ghana cedis. That's all. So key it in. So in your cost of consideration, put 30,000 there. Then relax. Let's assume that at the end of the first reporting period, the condition was the profit after tax must exceed 80,000. So let's assume that at the end of the first reporting period, the subsidiary is likely to achieve this. However, due to trading difficulties, due to what? Trading difficulties, the subsidiary will be able to achieve only 90% of this. So the subsidiary is 90% sure. So that means the fair value at the end of the reporting period will be what? 90% of 30,000. That would be what? 27,000. Wow. So here the parent have made a what? A gain. This is not a loss. Because you owe somebody a payment of 30,000 if the person fulfills certain condition. But it's unlikely, or the person might not fulfill 10% of the condition, which has released 10% of the burden away. So this 27,000 will be recorded in the books. Good. And then it will be recorded as a liability. So the third section will be a liability. The third section will be a liability. So it must be part of the parent's liability, the non-parent liability. In bracket parents in the parent book. Why? Because parent is owing the subsidiary. The parent is owing what? The subsidiary. Good. So that is all. So in short, 27,000 recorded in the books as a what? As a non-current liability, whilst 30,000 go to what? Cost of control. So the fair value at the beginning of the year must be recorded in where? The cost of control or the cost of consideration. So the fair value of the contingent consideration at the beginning will be recorded in where? Cost of control. Cost of control. Yeah. The gain will go to group retained earnings. Yeah, the 30,000 go to cost of control. So in short, this will be the accounting treatment. This will be the accounting treatment. In short, this will be the accounting treatment. So first, the 30,000 will go to cost of consideration because that's the fair value at the start of the year. Agreed. Then 3,000 will go to group retained earnings because the parent has made a gain because you made 30,000, but now it has dropped. The fair value has dropped to what? 27,000. Normal days market index. Good to determine this fair value. So when you are done, after adding the 3,000 to the parent profit, what you do is then you record a liability of what? 27,000. So you are owing 27,000. The following year, assess it. If it drop again, it's a gain for you. If it increase, then it's an additional provision. Turn non-current liability. Non-current liability. Depend on the time frame. If within a year, there's a time limit. So within the next 3 years, within the next 2 years, or within the next 6 months. So if it's within a year, then it must be a current liability. If it's going beyond a year, then it's non-current liability. I'm done with the cost of consideration. It's very important. You cannot solve control question without this. So take note. So your trial work will be November 2018. I'll project that one here for you. Then you try it nicely for me. That year we asked for the treatment. November 2018. No, it's a trial work. that you have to go look at it. Okay. So that is Fezo, Zatuna, and Mediama. Good. So required. Explain accounting treatment for deferred consideration and contingent consideration. Good. So that is it. In the context of acquisition of subsidiary by a parent, in the context. Okay. So that is it. So that's the trial. Great. Now let's continue the game. Let's continue the game. Now we are going to step 3. Very important. Net assets of the subsidiary. Step 3 is what? Net asset of the subsidiary. Net asset of the subsidiary. Good. So step 3. What we've done so far is step 1 and 2. Step 3, net asset of the subsidiary. Net asset of what? The sub. Underline it nicely. Net asset of the subsidiary. Okay, so net asset of the subsidiary. Here we're going to look at the net assets. So the net assets of the subsidiary. Here, the net assets, we are going to consider all equity items. All equity items. So go to the financial position and bring all equity items to form the net asset of the subsidiary. All equity items. Agreed. All the equity items. All of them. So let's see. All equity. Now here we have 2 shadows. And then the final one. We have at acquisition. At what? Acquisition and at reporting. Who can tell me the difference? At reporting, we have what we call post-acquisition. Post-acquisition. So it starts share capital, ordinary share capital. So share capital. Share capital. So much, so much. Here sometimes dash. Why? Because we assume that the subsidiary have not issued any share after the acquisition. Then retained earnings. Retained earnings. So much. So much. And then you get a figure here. Yes, don't forget the reporting currency. Then other reserves. Other reserves, such as capital surplus. So much, so much, so much. Good. This will be on the financial position. Please, to get post-acquisition, relax. It is the at reported minus at acquisition. This one is at reported. We normally call it the new. And this one will be the old, right? So to get the post, the changes is the new minus what old. How we get it? Great. So basically, that is it. So at reported, less at acquisition will give you post. Then you are done. They have what we call fair value adjustments. Fair value adjustments. So let's go to fair value adjustment. For the fair value adjustments, let me explain another issue. Now, we shouldn't be confused because net assets simple means total asset less what current liability. But now we are saying net asset is equal to share capital to be the same. Net assets in console we mean the equity. Good. The finance by. That's the net asset that we're talking about. Good. Which is always equal to the net asset calculation. That's what I mean that. Now, if you are going to buy a company, let us be honest here. You are going to buy a company, and then they are quoting two values for you. They are quoting the market value, and they are quoting the book value. Which one will you accept? Will you go in for the book value or you going for the market value? You're going for market value, right? Yes. This is called the fair value. So in short, we acquire the fair value of the net assets. In fact, we even tell you we acquire the fair value of identifiable net asset, what we can identify. If you tell me that you have some of the asset at Bokum, and I can go there, I'll not add it to it. What I cannot identify. So we pick the fair value, the market value. Why? Because the market value will not be manipulated. By the book value, your accounting policies, subjective accounting policies can change things, can manipulate it. So I don't like the book value. So no investor will be willing or happy to pay for the book value. I'm willing to pay for the market value if it's high and it's fair. That's fair value. Great. So that is it. So, but the financial statement prepared, there's a danger. The financial statement that they have prepared for you, they prepare using the book value. The book values. Oh, so we will give you the market values of the asset in the question, in the footnote. So when we give you the market values or the fair values, then you have to do what you call adjust the net assets. That's what we mean by what? Fair value adjustment. That's all. So we will give you the book value because the company they are reporting. Maybe they are using the cost model. But here we have to use what? The fair value. So let me give you a practical example. In the example, this is how to be. I'll give you plant. I'll give you land. And give you the useful life. 5 years remaining. And give you land as well. And give you building. Building 20 years. Okay. And give you market value or the fair value. I write fair value here. I write book value here. Fair value is 6,000. Plant. The fair value is 6,000. Book value is what? 4,000. And here, the fair value is 4,000. The book value is just 5,000. Jordan, the fair value is 10,000, but the book value was 12,000. Good. So now, they have used this one in the calculation. So this will be in the books. So the book values has been recorded. So what do we do? So you have to perform magic, or you have to adjust the net asset so that we can reflect the fair values in the books. Because I'm not sure you'll be happy to buy someone and then at the quoted value in the books. No, you want the market value, the fair value. So meanwhile, the financial statement that they have prepared, they have used what the book values, not the fair values. So that means we have to adjust certain things, the asset. So first, I write here fair value adjustment. So I'll compare. The fair value is 6,000, the book value is 4,000. So that means they've used 4,000. So here there's a fair value gain, right, of 2,000. So the fair value is in excess of the book value by what? 2,000. So I write plan 2,000, put it inside the book. So your fair value gain of what? 2,000. Here there's fair value loss of 1,000. Then there's fair value loss of 2,000. That is. Yes, everything you have to record, whether it's loss, fair value gain or loss. Now in exams, yes, the examiner will not present it nicely like this. When you do it like this, we are done. We solve the question. No, we won't do notes like this. This will be given to you in the financial position. Then this will be given to you in the footnote. Or in the footnote, we tell you that, and here our notes are almost the same every sitting. At the date of acquisition, the fair value of the asset of the subsidiary approximates their book values with the exception of an item of plant, which have a fair value in excess of its book value by 2 million. The remaining useful life of the plant is what? 5 years or 2 years, usually 2 years. We are done. Let me take it again. At the date of acquisition, the fair value and then the book values approximate the same value, or the book value of that of the subsidiary's asset approximate their fair value, with the exception of what? An item of plant, which have a fair value excess of 2,000 over the book value. At the date of acquisition, the remaining useful life is what? 5 years. We are done. So here in exams, you'll be given these values sometimes. So at the date of acquisition, the asset book value is equal to the fair value, except some few items, such as plant, which have excess of fair value over the book value by what? 2,000. So how do you treat it? We are done. So let's go to the books. So let me take this section off a bit so that I can record it in the net asset. So I record plant here. I'll put a 2,000 here. There's a gain of 2,000. I'll put it here. Gain, I'll add. Loss, I'll subtract. So if the fair value gain, just record it here at acquisition. Now, most cases, it has not been accounted for. So you record the same figure at reporting because they have not record any figure. If it has not been accounted for, account for it. So what do? You record it again. Here will be dash because if I put 2,000 here and I put 2,000 here, then the difference is dash. So 2,000 minus 2,000 gives me 0. However, if there's something inform you that the subsidiary have accounted for this, then at reporting it will be dash because they've accounted for it. By the acquisition, they will never account for it at acquisition. So take note. Because the acquisition will be 2,000. This minus this will give us minus. Put in brackets. Great. So that is it. These are the changes, and you're going to meet one of them exactly in your exams. Yeah? 0 minus 2,000, what's the answer? 0 minus 2,000. Okay. When you go to building, land had a loss, right? So land, there's a loss there. So I'll go again. Land, there's a loss of what? 1,000, and then building loss of 2,000. I'll go to land. I'll go to building. So land, there's a loss of 1,000. I'll put 1,000 here. Brackets, negative. If they have not recorded it, I'll put 1,000 here. Here will be that show. That is it. Please and please again. Wow. Please let me mention this. Any figure or any item that you record it at reporting, you record it. You don't copy it from the question. It must be accounted for or it must reflect. You have to record it again in the books. Again in the books. That's at reporting on the statement of financial position. So the building 2, There was a loss of 2,000, so to be a loss of 2,000, in brackets, loss of 2,000, in brackets, I'm done with the fair value adjustments. Okay. Now let's go to the heartbeats. So fair value adjustments. So maybe plant. I'll talk about only plant. So much, so much. Then I am done. Now, anytime there's fair value adjustment, it will create what you call additional depreciation or excess depreciation. That's the turbo section. Anytime there's what? Fair value adjustment. So let's recall our old example. Plant, the life was 5, 5 years remaining. For the plant, there was a fair value gain. So fair value gain of 2,000. So that means it will create what we call excess depreciation. I don't go to the long story. Can you use the video to get the long section? I'm cutting things short. The excess depreciation with the plant, the book value, the question that we just solved. Let me locate. Market value, we have 6,000. Book value, we had what? 4,000. So now tell me, which value would they calculate depreciation on? They are going to calculate depreciation on the book value. Yes. Meanwhile, we don't acquire the book value, we acquire what? Market value. So it means that they are calculating depreciation on the wrong value. So what do you do? So meanwhile, the depreciation must be based on the 6,000. Good. So if the useful life of the asset is 5 years, if they should have calculated it on 5, what will be the answer? Now they are calculating it on what? This. So what will be the answer? So depreciation will be like this. Let's perform some small trick here. So divide this one by 6,000. What do you get? This one by 4,000. What do you get? Divide 6,000 by 5 years. Because the useful life of the asset remaining is 5 years. They'll tell you. So 6,000 by 5. So 1,200. The depreciation per year is 1,200. And 4,000 by 5. 800. So that means depreciation, it has created what we call excess depreciation. Excess or additional depreciation. So anytime they are two different not together. Additional depreciation and excess depreciation. This is additional depreciation. This is additional depreciation because the depreciation that they are charging is 800. As a result of this assignment or this adjustment, depreciation has increased to what? 1,200. So you have to charge additional depreciation of what? 400 per year. So every year it will create what we call additional depreciation of 400. But in exams, the examiner will not bring this book value, market value nicely like that. No, they will tell you that the gain is 2,000. That's all. If the gain is 2,000, divide the gain by the number of years remaining. It will also give you the additional depreciation. So this 2,000 divided by 5 years, that will give us 400. That's what we have to just get. Now, getting this 400, how do we treat it? We call it additional depreciation. So anytime there was fair value gain, it will create what we call additional depreciation. That is the fact that we have to get it. Anytime there's fair value gain, it creates what we call additional depreciation. That means the depreciation that they've charged is smaller. So we have to top it, then top up the depreciation. However, if it is fair value loss, it will create what we call excess depreciation. They've charged depreciation more than they should. So that one, I have to reverse it. And all of this, I have to treat it. So how do you treat the excess depreciation? So let's go to the books. So record here depreciation or excess depreciation. Open your bracket, calculate it, 2,000, the gain divided by the number of years remaining, times the period of consolidation, cumulatively, so times the period of consolidation. If it is 1 year, 12 over 12. If it's 6 months, 6 over 12. Don't forget. Now put it here, 400. You put it here, 400. You put it at what? At reporting. This is the profit of what? The subsidiary. So you subtract it. Right. So you subtract it. And then you go to post acquisition, you subtract it again. Because 400 minus 0. At acquisition, it will be 0 or nothing. That is okay. Then you continue the game. Now let's continue the game. 11, one more item, then we are done with the net asset acquisition. Then we go to call unrealized profits. Unrealized profit, I'll explain. That is if the subsidiary is the seller. So unrealized profit. Unrealized profit. Great. If it happens to be excess depreciation, that one you add back. So whenever you add again, its depreciation must be subtracted. Whenever you subtract the fair value loss, its depreciation must be added back. And please, we said that any item that you place here, you have to subtract it from where? The PP. In fact, I will explain more when I start the actual calculation. If I do it here, will not get so kindly be with us when we start the actual calculation. When you go to the PP schedule, you have to go and learn it from the PP. Yes. You have to learn it from the PP schedule. So you are subtracting from here and then subtract from the PP schedule. So this must be subtract from the PP, subtracted from the PP because depreciation. It is creating additional depreciation. However, if it happened to be excess depreciation, there was fair value loss. Let us know this one happened to be fair value loss. How are you going to do it? Fair value loss of 2,000. You divide it by 5, you still got 400. That one, because it's a fair value loss, that one, you will subtract this fair value loss. The entire fair value loss must be subtracted. And then it will create what we call excess depreciation, which must reverse back. We add back. So excess depreciation will be added back to the profit. That's all. Then we are done. Then you add your unrealized profit. I will explain in the workings. There are some items that one will use workings to do. That one will be at reporting, and then still be at post. We are done. This is all. Unrealized profit is an additional expense, the provision. So which must be subtracted from the subsidiary's profit. That's all. Good. Then you double underline it and total both sides. So you get total net asset at acquisition. Some all up here is at acquisition. Some all up here at reporting. Some all here total post acquisition changes in the net asset of the subsidiary. That is the full name. Is that? If there was any assets or liability or expense which has been incurred by subsidiary, but it has not been taken care of, refer to it here. Both asset, liability, any transaction at all. So that is it. Okay. Now let's move on with the game. I'm done with the net assets. From here going, when I pick a focus there, we look at the net assets at acquisition. We are still familiar ourselves with the issues. Okay. Okay, so let's move on to the next step. These are the steps that we go through. Step 4, then we calculate the goodwill. Step 4, goodwill. So step 4, the goodwill. Great. So step 4 will be So the next step that we are going to look at it will be the goodwill. So this is where we are going to treat the goodwill. 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 So first, step 4, goodwill. As soon as I'm done with all these steps and treat some little issues, which I'll do all of them today to end all the steps issue. So when you pick any question, we are solving it. You understand everything? Goodwill. Now with the goodwill, it has so many definitions and so many nicknames. It is the excess of the purchase consideration over the net assets of the subsidiary. Let us you're going to buy something. You've acquired a vehicle. You know that the market value of this vehicle is just 30,000 Ghana cedis. That's the market value of the vehicle. But the person sold the vehicle to you at what? You bought it at 35,000 cedis. Wow. Meanwhile, the market value is 30,000. So the excess amount that you pay over the book value or over the net asset or over the market value, how much is the cost at the market value? So the goodwill becomes what? 5,000, period. So goodwill is the excess of what? Purchase consideration over the net asset of a subsidiary. So compare two items. The consideration transferred and what? And the fair value of the net assets of the subsidiary at acquisition. Please, the net asset must be at acquisition, not at reporting. And we are done with net asset, step 3. So go and pick the total for at acquisition and come and bring it here. We are done. Good. So that is the goodwill. So goodwill is nothing but what? The excess of the purchase consideration. So excess of purchase consideration over the fair value of the net asset acquired. Net what? Asset acquired. That is the goodwill. But please let us be a bit careful about the calculation of the goodwill. There are two types of goodwill. There are what? Two types, or there are two ways in which we can determine the goodwill. All of them depend on how you value the non-controlling interest, the NCI. Non-controlling interest. That's NCI. So there are two ways of valuing NCI, and then it gives rise to two ways of calculating goodwill, period. Two ways of valuing NCI and it gives two ways of valuing goodwill. We are done. So we are going to take our time and go through. Please, it's a must. You should know all these types. In exams, you may be called upon to use any of them to calculate for the goodwill, and then you are done. Okay, so that is it. So let's look at the two ways of valuing NCI. So that gives rise to two ways of valuing what? Goodwill. We have what you call, in fact, the methods are two. Let me see the two methods. The two methods are, they have so many names. I write all of them for you. We have what you call fair value method. Fair value method. That's the first name. We also call it the full goodwill method. Full what? Goodwill method. Full goodwill method. We also call it the new method. I don't like the name because it was recently introduced after the revision of the IFRS 3 business combination. Good. Then you go to the method 2. So this is the method 1. The type 1. Type 1 fair value method. So let me write type 1 and then the type 2. Type 2 or method 2 or the method 2 we call it the proportionate interest method. Proportionate interest method. Proportionate interest method. So proportionate interest method. Let me write the full amount here. Proportionate what interest method. That's the first name. Name number 2. Please, this is not half goodwill. So you can also call it partial goodwill. Partial goodwill. It's also called share of. In fact, each one when the examiner writes it in exams, it normally confuses. So let me write it. Okay, let me also write it here. Share of fair value of identifiable net assets. Identifiable net assets. Good. Now, I'll come with another features again. It's also called the goodwill for parent only. Only parent goodwill. Only what? Parent goodwill. Now, the fair value is for both. The only parent goodwill is for that of the proportionate. Let me write it here. Only parent goodwill. Then, with the that of the type 1, the fair value model is the goodwill of the parent plus the subsidiary. So, goodwill of the parent and the NCI, goodwill of the NCI. So, that is it. So, take notes of that. So, with the type 1 or the fair value model or the fair value section, the goodwill is that of the parent plus that of the NCI. That's all. So now we know goodwill. So basically, in fact, don't worry, I've given you all the names. Please take note of this. Let me circle this name for you. I'm using this. They say share of fair value of identifiable net assets. Please, if you see fair value inside, that does not mean it's for fair value model. Let them tell you fair value model. Fair value model. Good. Fair value model. Great. Let them tell you, even though there's fair value model here, this is not a fair value model. With the type 2 is the proportionate interest method. That one, the good rules for only parent, the parent share of the identifiable net asset. That's all. We are done. So that is it. Now I'll take my time and give you the format for this one and then this one. We are done. Then pick one question to calculate the goodwill of that of under each section. Right from goodwill, level 2 calculations, then we are done. Then we move on to the footnotes. Yes. Now let's take our time and look at how we can calculate what the goodwill using the fair value model. All of these are the same. They are the same method, or like they are the other names that are provided. Other names. Don't forget the examiner will use just one. Normally, the examiner will use this one, fair value model, or full goodwill method. That's all. These two, that's all. The examiner not use new or the old that I have there. No. the owed. So good. So that is it. New and then the owed. So let's start. How to get a goodwill for that of using a fair value model. Kindly follow these steps and you are fine. It's a formula work, it's a format work. Then that's all. What you do is this. Goodwill, fair value method. Fair value method. The format is like this. All these workings must be done before you can complete a financial position question. All these workings up to 6 or 7, standard one, plus the footnote issues. Good. So first, you bring the fair value of the consideration transferred. So cost of consideration. So the first item will be cost of consideration or cost of control. So cost of what? Control or cost of consideration from workings number 2. Great. So just lift it and come and put it here from workings number 2. So much. Then you pick the fair value of NCI. Fair value of NCI at the date of acquisition. I will explain that one too. Fair value of what? NCI at the date of acquisition. Add it. Because we call total consideration transfer. So this one becomes total consideration. Now let me explain this to you. You know that the subsidiary, we have acquired a percentage of the shares, right? We acquired, let's say, 75% of the shares. Oh, other people also have acquired 25%, right? Now, fair value or method or the full goodwill means goodwill of what we paid plus goodwill of what other people paid, putting together. That gives us a full goodwill. It's a goodwill of what? The parent, and the parent have acquired 75 plus the goodwill of what? The NCI. NCI has also acquired 25. That makes it full goodwill. So what everybody paid must be taken into consideration. This is what parent paid. So parent, that is the cost of control. Then fair value of NCI, this is what NCI also paid to acquire their 25%. Usually the examiner will give it to you. Or there are 3 ways. I'll do that when I'm solving questions. I'll do this when I'm solving questions. Good. So that is it. So putting what parent paid, this is what parent paid, what NCI also paid, to give you total cost paid for the entire company. So that's the total. Now you list how much the cost, the fair value of the net asset. So less fair value of what? Net asset at what? Acquisition. The entire net asset. So this is what we call goodwill at acquisition. Goodwill at what? Acquisition. I like that. That's all. So let's assume that the parents, that 25,000, sorry, that 75% that the parent acquired, let's just assume that parent paid 30,000, 30 Ghana. NCI paid 10,000. So therefore, the entire amount paid to acquire that company or to acquire the shares of that company would be what? 40,000. How much that company, their net asset wealth? Oh, their net asset was, and this net asset is coming from workings number 3. Net asset at acquisition. Maybe the net asset is around 36. Oh, so that means we paid excess by what? 4 Ghana cedis. So that 4 cedi become goodwill at what? At acquisition. Immediately you acquire the guy, you calculate goodwill, and that one is what? 4 cedi. This goodwill is combination of what? The that of the NCI's own and what? the parent own. We don't have enough time. I could have illustrated alternative to arrive at the same answer. Let's go by this. This one is okay. Yeah, this one's a very short one, and it's okay. Good. Now, goodwill is an intangible asset and must be accounted for in accordance with what? IAS 38. Which, yes, and IAS 38 within zone. Now, goodwill is an intangible asset which must be accounted for in accordance with what? IAS 38. Now, with the IAS 38, it says that any intangible assets that do not have a definite life, it must not be amortized, but it must be tested for impairment each and every year. So goodwill, we don't impair, so we don't depreciate or amortize goodwill, but we impair goodwill. So impairment. So you bring the impairment here, so much, and then you subtract it. Okay. Then you take it off. So when you subtract impairment is like the same as what? Depreciation, amortization, the treatment. Goodwill, we don't depreciate or amortize goodwill because we don't know the life. Because if you acquire a subsidiary, you don't know the end of that subsidiary. So therefore, the goodwill must not be amortized. Instead, it must be impaired. So goodwill will be impaired. So this, after the impairment, then you get the goodwill at reporting. So this one becomes goodwill at what? Reporting. And this is what you put in your financial statement. That's a goodwill at what? At reporting. Perfect. So goodwill at reporting. Basically, that is it. So I'm done with the fair value method goodwill. And this impairment must be shared between two people. Have you seen? Why? You have to go and share this impairment if you're using the full goodwill method, because here is the goodwill of the parent, the 75% plus the NCI. So whatever parent profit is, let's go there and subtract his share of the impairment. That's all. And parent profit, we will see it is workings number 5. We call it group retained earnings. That's the next workings after here. That's where the parent profit will go. So when you go there, go and share the impairment. Why? This impairment is not for only. The goodwill is for both parents, which owe 75, and what? NCI, which owe what? 25. So if there's any enjoyment, you have to also share. And then if they are sharing enjoyment 75 against 25 and there's a loss, when they share, they have to also share the impairment. Any loss must be shared. So impairment loss must be shared. NCI profit is workings number 6. So go to NCI to reporting. Then we are done. Great. Perfect. Now let's move on with the game. Now let's go to the proportionate interest method. Let's go to the proportionate interest method, the method 2. You cannot use both methods at the same time. The examiner will tell you which one to use. If they don't tell you, just look at the items made available. Some of the questions, if the fair value is not given, that means you cannot use the fair value method. If the fair value of NCI is not given to you, then that means we can use the proportionate interest method. Good. Let's go to the method 2, proportionate interest method, how the format look like. And that one too, we are done. Proportionate interest method, how the format look like. So the difference between goodwill at acquisition at reporting is we subtract impairment from it and get at what at reporting. And then impairment is like it's like depreciation. How we treat depreciation is the same as impairment, but they are different thing altogether. One is what? Deliberate, and one is what? Negative. Okay. Now let's move on to the second format. Then we are done. Today we look at all the standard workings and then left with the just little issues that I will explain them. So the method two is the proportionate interest method. Now the proportionate interest method, the good rules for only parents. That one use red pen to write it. Only parent good rules. So everything must be for parents. So that's what we call a share of the proportionate interest method. You only take your share, only parents. Okay. So good rule is for only parents. So it's not like this. So the cost of consideration, step two. Cost of control or cost of consideration, step two. So much. Then you say less what? Parent share of net assets at acquisition. Net assets the parent share of the net asset at acquisition. Only parent share. We are done. This is the goodwill at acquisition. So goodwill at acquisition. We are done. Then still goodwill. Goodwill. Sorry, the impairment. Not good. Impairment. So impairment. Impairment. Now this only parent. So impairment loss. Less it to get goodwill at reporting. Goodwill at reporting. You are done. However, this impairment it must be for only parents. Only what? Parents. Why? Because the enjoyment, the goodwill is for only parents. So the impairment must also be for only parents. That's all. It must reflect parent profits. And parent profit is the step five. Group retained earnings. That's what we are going to do after this. Group retained earnings. So that's the end of the goodwill calculation. So there are two methods. The examiner will make it clear for you. So select one. That's all. Cost of control, that's a step two. Cost of control, that is a step two. And then we are done. Cost of control. Good. Now let's move on to the next working. Now, now before we move on, let me push your confidence more. Great. So, question like this. Now, let me tell you, on April 1st 2019, acquired 60% of what? 75 million equity shares of Showman. So that's JDM acquired what? 75% of. Yeah. So that was the similar one. Equity shares of Showman Limited. The acquisition was achieved through share exchange of one share for now for every three shares in Showman. At acquisition, the share price of both NA Limited and Showman Limited were 4 and 2.5. Now I'll explain this one too. If you see the share price of the subsidiary too, it means that the fair value of any share will not be given to you. You have to calculate it yourself. That's all. That's full goodwill. That's full goodwill. But let them tell you first. Good. Now let's move on. In addition Now Limited will pay 1.4 million cash on 31st March 2020. You acquired them when 1st April 2019. So exactly 1 year, right? So exactly 1 year or more than 1 year. So from 1st April 2019 to 31st March 2020, 6 months or 1 year. Then you find it. That's the deferred consideration. Cost of capital for now limited is what 10%. That's all. You are done. Plus some nice footnotes. Then you are done. Good. So basically, that has been the game. Okay. If you check this one to November 2008, just explain the accounting treatment of deferred consideration and contingent consideration in the context of acquisition of subsidiary by a parent. Good. So basically, you'll be fine. By the time, if you can go through all the videos, I can guarantee your success in the consolidation. You can go to all of them. Or not the one that you understand, you go to the one I don't understand, you leave it. No. All great. All of them. So basically that is it. So okay, now let's continue. And I'm going to look at the step 5 and step 6. And we are done for the day. So we are now with the standard steps so that but I'll add associate to it so I'll complete the game. So step 5 is called group retain earnings. Group retain earnings. Group retain earnings. Group retain earnings. That is the step 5. Group retain earnings. Yeah, how do you do these workings? We saw empty consolidation last week. A very simple one, no footnotes. That was last Monday. Good. So now the group retained earnings is a retained earnings for the parent company and the parent share into the subsidiary. That's all. So first, take the retained earnings of the parent. So retained earnings all of parents. So parent retained earnings. Parent retained what? Earnings at reporting. At reporting, so much. Then parent share. So all parent retained earnings at reporting, put it there. Then the parent share of the subsidiaries post-acquisition changes in the net assets. Have you seen the step 3, the net assets? Is that at acquisition? Is that at acquisition? Is that at reporting? And we say post-acquisition. Working standard 3. The final answer at the post-acquisition. Parent must take the share. That's all. It's shared between parent and then the subsidiary. So parent will take a share from that. So we call it parent share. Yes, parent share of post-acquisition changes in the net assets or post-acquisition profits. Post-acquisition changes in the net asset, parent share. You just open your brackets, check the parent percentage holding. Let's assume that is 60%. So 60% times that figure. Whatever you get, you put it there. Good. Then what again? You bring. Then you bring your impairments. Impairment, so much, you subtract. That's the parent share. The parent share of the impairment. Then, after impairment, you bring unrealized profit if the parent is the seller. We'll explain unrealized profit. So, let me get the format for me. Unrealized profit if the parent is the seller. If P is what? Seller. Both. If P is seller. If P is the seller. The parent is the seller. If the subsidiary is the seller, it will go to where? Net assets. Good. That's step 3. Then if there's unwind of discount, you bring it in. Those stuff, I'll not list them here when you come across them. Unwinding of what? Discounts must be added to that of okay, let me add it there. Unwinding of discounts will affect the group retained earnings. Then what again? Then you add associate profit. So when I treat associate, you come and add associate profit. Parent share of associate profit. You know associate, right? Associate, where you have from 20% up to 49% interest in a particular company. You don't need to consolidate that company. Don't consolidate it because you don't have control. So what do? Just take your share of profits at the end of each year. Take your share of profits. So share of profit from associates will be added. So take note. Because I'm not detailed, that's why I'm not bringing it. I'm done. When I'm done, you put all this together. It goes to the financial position. Then we are done. It goes to what? The financial position. Great. Now let's continue the game. Now let's go to the step. The step 6. So let's go to step 6. There we are done. Step 6. There we are done. Step 6. And I have maybe 1 or 2 stuff. Step 6. Step 6. Good. Step 6. Step 6 is what? NCI at reporting. NCI, non-controlling interest at reporting. Yes, exams can write NCI. Yes, exams can write NCI. Because so far, it's the only shortcut that we have, NCI, non-controlling interest. So NCI at reporting. So that's the reference number 6. NCI at what? Reporting. That's the NCI figure that will go to the financial position. Normally, I put financial position here. So there are 2 NCI. One go to profit and loss, one go to financial position. Here we are doing consolidation of what? Financial position. So what goes to financial position? That's what you are interested in. When we are done with the financial position, satisfy ourselves with financial position, we come and pick what? Profit and loss. When we are done, we put the 2 together and put one full question. Pick one full question that contains what? The profit and loss and then the financial position. Which occurred in where? 2017 May. Okay, now let's continue the game. NCI to report. Yeah, there are 2 ways. There are shortcuts there. Let's see. First of all, here there are 2 methods. Because we said that there are 2 ways of valuing NCI. That gives rise to what? 2 ways of valuing goodwill. There are 2 ways of valuing NCI, giving rise to 2 ways of valuing what? Goodwill. So NCI, let us be using the fair value method. So let me use the fair value method. With the fair value method, first, you bring the fair value of the NCI at acquisition. Fair value of what? NCI at what? acquisition. Fair value of NCI at acquisition, so much. When you are done, you add the NCI share of post-acquisition changes in the net asset. So NCI share, so you can write your share of post-acquisition changes in the net asset. What you give the parent share, NCI must also take their share. However, if in a question it is about wholly owned subsidiary, with a wholly owned subsidiary, we don't need any NCI. There's no NCI in wholly owned subsidiary. Have you seen? Your parent owe everything. So there's no NCI. So that one, there will not be any NCI, wholly owned subsidiary. Then, then impairment. Impairment will come in if you are using the fair value model. Impairment, so much. Impairment. That's the NCI share of impairment. So it must be share, not full impairment. You share the impairment between parents and what? The subsidiary. Exactly. So we are using the fair value method here, impairment. Then basically we are done. Good. Right after this, then end this section. You put all this together, impairment, can you subtract impairment? Then you get the NCI at what? Reporting. So NCI at reporting. This is the fair value method. This is the fair value method. What if you are using what we call the proportionate interest method? B. So let's do the proportionate interest method. Because we said there are two ways of value NCI. That is it. Two ways of valuing what NCI. Fair value or proportionate interest method. So if you are using the fair value, this is how it will be. Let's go to the proportionate interest method. Proportionate interest method. That one is straightforward. Just bring the share of NCI share of net asset at acquisition. So NCI's share of what? Net asset at acquisition. At what? Acquisition. Share of net asset acquisition. For that one, there are two methods. There are two. Yes, I'll give all of them to you. Okay. So NCI share of what? Net assets at acquisition. So NCI share of net assets at acquisition. So much. Then NCI share of profit. So share of what? Profit. So share of profit. You add it to it. That's all. End there. No impairment. Profits coming from where? Net assets. The post-acquisition changes in the net assets. Or let's call it post-acquisition changes in net assets. So share of what? Post-acquisition net assets. Post-acquisition changes in the net assets. That's all. We are done. Alternatively, this one, alternative formula is nothing by you just pick your calculator and multiply a net asset at reporting by the NCI's percentage. That's all. To give you the same answer. Please here, no impairment though. No impairment. Why? Because the goodwill is only for what? Parents. So the impairment to it must only be for parents. That's all. I'm done with the working 6. But let me waste it with working 7. I'll end at working 7. Then that means you have all the workings. What left for us to do, or the remaining section is the uh, those workings come in a note. That's a group intra-group adjustments. You create a workings for intra-group adjustments. You create a workings for then that's all. After the working seven and the intra-group adjustments, then the rest you do it on the face. So that is it. Then we start the full question. The full question. So let me add that one to it quickly. Let me add that one to it quickly. Okay. So workings number seven. Investment in associates. I like that. These workings exist if there's associates in the question. If there's no associate, don't worry yourself. So investment in associates. Investments in associates. That's workings number seven. You only need this working if there's associates in the question. If there's no associate in the question, you don't need these workings. Good. Yeah, we said that associate. We don't consolidate associates. Instead, we only take our share of profit. In associate, we call it what? Investor and what? Investee. Great. So with associates, we don't consolidate associates. Associates where you have what? From 20% up to what? 49% interest in the person. You don't consolidate. That is it. So instead, on the financial position, it's an asset because it's an investment. Investment is an asset, non-current asset, right? So after the goodwill or after your PPs, try and add it. Good. We are going to use what you call equity accounting method. Equity accounting method is a very huge term, but simple in explanation. So if you go to examiner asks you explain how assets are accounted for using the equity accounting method, they are not asking for anything too strange. They are just asking for what you are going to do. Equity accounting method say relax, do not consolidate associate. Instead, account for your investment by picking two items: the fair value of the consideration paid and the post-acquisition changes in the net asset of the associate or of the investee. So for investment in associates, equity accounting method states that we have to one bring the fair value of the consideration transferred or paid. So fair value of consideration, fair value of consideration is so much plus the post-acquisition changes in the net asset of the investee or of the associate. Okay, you can't say subsidiary because you don't have control. So we are using equity accounting method plus what? The share of post, we say post acquisition, there's no acquisition. Share of changes in the net asset. Share of what? Changes in the net asset. Or post acquisition changes in the net assets. Like acquired, the 15% that you've acquired afterwards. What is acquisition? Post acquisition changes in the net assets. Good. So you bring it here so much. Then you go to the third one, less any impairment. But here there's way of doing it, less impairment. So I'll pick a question where the associate there's impairment affecting the associate. Good. Yes. This impairment is special. I will explain that impairment. And then unrealized profit, we call it upstream and downstream. So that's the investment in associates. Good. That's the investment in the associates. Then we are done. So on that note, we are done with the standard workings. So now what left are the two items. So please, there'll be, but kindly use the videos. The next one to get the following. These are the next items that we have to do. The next item we have to do the treatment of intra-group adjustments. We call it intra-group adjustment. That one comes in the footnote. There are a lot of them. One, we have intra-group sales. How do you treat intra-group sales? Two, how do you treat unrealized profits on sales? Unrealized profit. How do you treat how do you treat the intra-group debt? All of them you will do justice with. As soon as you know how to treat this, that's all. Then we can now pick a 4 question and do justice with it. So kindly take note of that. And thank you very much for coming. So on that note, this is how far the good Lord will bring us. On that note, we'll end here. Good. Kindly don't forget to subscribe to the channel. Great.